Costs. Amortization. The spreading out of a big cost over time. The business pays off the loan through monthly amortization over 5 years. Budget. A plan or to plan how much money will be available to spend. We unfortunately went over our budget because of unexpected costs. Capital expenditure. Money a company spends to buy or improve long-term assets like buildings, equipment, or vehicles. Investing in solar panels is considered a capital expenditure because it provides long-term value. Cash outflow. Money going out of a business to pay things like salaries, rent, bills, or supplies. It's important to monitor cash outflows to avoid running out of working capital. Costings. Detailed calculations of how much something will cost. We calculated the costings for the new project and realized it would be too expensive to undertake. Depreciation. The gradual loss of value of a physical asset over time. Computers lose value quickly due to depreciation as they break easily and become quickly outdated. Direct costs. Expenses that can be directly linked to making a specific product or service. Raw materials and assembly labor are typical direct costs in manufacturing. Economies of scale. When a business reduces the cost per unit by increasing production. Small businesses often struggle to match the economies of scale of larger firms. Expenditure. The money spent or costs incurred by a business or person. Our total expenditure has almost doubled this year due to the cost of steel and aluminium. Fixed costs. Business expenses that stay the same no matter how much you produce or sell. Luckily, our fixed costs remained the same, even though we started selling so many more products. Hidden costs. A cost that is not obvious or expected at first, but still affects the total expense. The price looked low, but there were several hidden costs like delivery and installation fees. Income tax. The money individuals or businesses pay to the government based on their earnings or profits. Income tax rates in most countries varies depending on how much profit a business makes. Interest. Money paid for borrowing money or money earned from savings or investments. If we borrow money from our bank, they'll give us a good interest rate. Labor costs. The total amount of money a company spends on paying its employees. Rising labor costs will undoubtedly affect the price of the final product. Maintenance costs. The expenses involved in keeping equipment, buildings, or machinery in good working condition. We keep our maintenance costs down by servicing the machinery ourselves. Operating expenses. The day-to-day costs a business incurs to keep running, excluding the cost of making products. Rent and electricity are common operating expenses that we can't avoid. Overheads. Regular business expenses that are not directly tied to producing goods or services, but are needed to keep the business running. We include office supplies in our overheads budget. Overrun. When something, like a project or budget, goes beyond the planned time, amount, or cost. The construction project had a cost overrun of 20%. pay up front. To pay the full amount of money before receiving a product or service. Our suppliers ask us to pay up front for the goods before they send them to us. Variable costs. A cost, such as utility bills, materials, and shipping, that can change in price. Shipping expenses are part of the company's variable costs.